Meet Marcus. Marcus is 34. He's a project manager at a mid-sized company in Columbus, Ohio. Last year, he got the raise he'd been grinding for. 18 months of long hours, skipped vacations, an ego-crushing performance review. And finally, his salary crossed $80,000. He went home that night and felt like he'd made it. He took his wife out to dinner. They talked about maybe buying a house in 2 years. Then the first paycheck came in, and Marcus did the math. He got a $12,000 raise. His take-home went up by $520 a month. He lost his subsidy on the health insurance marketplace. His student loan payment jumped because his income-driven repayment amount recalculated. He no longer qualified for the child care tax credit. Marcus made $12,000 more and felt $200 poorer. That is not a personal finance failure. That is a systems problem. And today we're going to name it, explain it, and, most importantly, show you how to stop getting punished for trying to get ahead. There's a concept in healthcare called the Medicare Part D donut hole. It's a coverage gap, a zone where you make too much to get full benefits, but too little to actually afford things on your own. You're stuck in the hole. The middle class has its own version of this, and almost nobody talks about it. Here's how it works. Below a certain income, government programs, tax credits, and subsidies catch you. Above a certain income, like significantly above, you earn enough to absorb costs and build wealth on your own terms. But in the middle, you're in no man's land. You make too much for Medicaid, too much for SNAP, too much for full ACA subsidies, too much for the maximum earned income tax credit. But you don't make enough to comfortably pay full market rate for all those things and still save, invest, and build a life. That gap, that donut hole, is exactly where tens of millions of Americans live. And the cruel irony? Every raise you get can shove you deeper into it. It's not that you're bad with money. It's that the system was designed with a gap in it, and you fell in. Let me show you the math, because this is where it gets real. Let's say you're a single parent making $48,000 a year. You qualify for a meaningful ACA health insurance subsidy. Let's call it $400 a month. Your income-driven student loan payment is $190 a month. You get a $2,000 childcare tax credit. All in, the government is supplementing your life to the tune of roughly $8,000 a year. Now you get promoted. New salary, $62,000. You made $14,000 more, so you should be way ahead, right? Not so fast. Your ACA subsidy drops by $280 a month. That's $3,360 gone. Your loan payment recalculates up by $120 a month. $1,440 gone. You phase out of the childcare credit partially. Another $500. Your marginal tax bracket bumps up, so more of that new income goes to federal taxes. Do the actual math, and you're netting maybe $4,500 to $6,000 of that $14,000 raise in real, spendable dollars. That's not even touching lifestyle inflation. The gym membership you got because you finally feel like you can. The slightly nicer car because the old one was unreliable. The restaurant habit that crept up. And here's the part that sounds controversial but is just true. Sometimes, in specific situations, a raise can make you measurably worse off in the short term. Not because of bad decisions, because of benefit cliffs. The point at which crossing an income threshold causes you to lose more in assistance than you gained in income. These are real, documented, and studied by economists. They're not conspiracy theories. They're policy failures. Okay, here's where I'm going to say something that might make some people uncomfortable. The standard advice, work hard, get promoted, earn more, is correct. I'm not telling you to stop pursuing raises or stay at a lower income on purpose. That's not the move. But here's the controversial part. Chasing gross income is the wrong goal. Most people optimize for their salary number. That's what you brag about. That's what LinkedIn celebrates. That's what makes you feel successful at dinner parties. But what actually matters is net spendable wealth, what you keep, what you build, and what your money does while you sleep. A person making $75,000 who maxes a 401k, contributes to an HSA, owns a home with equity, and has no consumer debt is financially ahead of a person making $95,000 who pays full price for everything, carries a car note, and saves nothing. The number on your offer letter is not your financial reality. And the system, the tax code, the benefit structures, the phase-out cliffs, is built around gross income. So if you only manage gross income, you will get crushed by it. The people who win in the middle-class donut hole are the ones who learn to manage their effective financial picture, not just their salary. There are 3 exits from the donut hole. I'm going to give them to you straight. Exit 1. Reduce your taxable income aggressively, not your income itself. This is the single most underused tool available to middle-class earners. Every dollar you put into a traditional 401k reduces your adjusted gross income, the number the government uses to calculate your benefits and tax bracket. Same with HSA contributions, traditional IRA contributions, and certain business expenses if you have a side hustle. A person making $72,000 who contributes $23,000 to their 401k has an AGI of $49,000. That person may qualify for benefits and credits that their neighbor with a $55,000 salary and zero retirement contributions does not. You are not cheating the system. You are using the system as it was designed. The government wants you to save for retirement. They built in these incentives intentionally. Use them. Exit 2. Build income streams that don't count as W-2 wages, qualified dividends, long-term capital gains, certain rental income. These are taxed differently and don't trigger the same benefit phase-outs that your paycheck does. This is a longer game. You don't build investment income overnight, but the people who eventually float above the donut hole entirely are the ones who diversified how their money comes in, not just how much. Exit 3. Stop optimizing for the salary number. Negotiate the total package. Employer-paid health insurance doesn't count as income to you, but it's worth $15,000 to $25,000 in value. Remote work saves commuting costs. A strong 401k match is effectively a salary increase that never hits your AGI. If you're evaluating a job offer based purely on the number after annual salary, you are leaving a lot on the table. The middle class gets squeezed because we're playing a salary game in a benefits and tax efficiency world. Look, I'm not going to pretend that optimizing your 401k solves systemic policy failures. The donut hole is a real structural problem, and it deserves real policy attention. There are economists across the political spectrum who agree on this. But here's what I can tell you. Waiting for the system to fix itself is not a retirement strategy. The people I see actually building wealth in the $60,000 to $110,000 income range are not the ones who got the biggest raises. They're the ones who got financially literate about their own situation, who learned where the cliffs were, who started using pre-tax vehicles early, who stopped treating their gross income like their scorecard. Financial awareness is not just a nice skill. At this income level, it is worth tens of thousands of dollars a year. That's not an exaggeration. That's math. Remember Marcus? Marcus didn't give up on raises. He didn't ask his boss for less money. But after doing the math, really doing it, he started maxing his HSA. He bumped his 401k contribution to 15%. He refinanced on an income-driven plan and actually recalculated what income level optimized his loan payments. His gross income kept going up. His effective tax burden went sideways. His benefits barely changed. And his net worth started actually moving. He didn't get a windfall. He didn't go viral on TikTok. He just stopped letting the system quietly eat his raise before it hit his bank account. That is available to you, right now, with the income you already have. You don't need to earn your way out of the donut hole. You need to think your way out. If this video made you rethink how you're looking at your next raise or your current salary, share it with someone in your life who needs to hear it. They might not even know they're in the hole. Subscribe if you want more content like this. No fluff, no get-rich-quick nonsense, just the math and the mindset that actually moves the needle. And drop in the comments. What's one benefit or credit you lost when your income went up? I read everyone. See you next week.